What happens when the world's biggest economy runs up the largest debt in history and the stock market still celebrates? The US national debt just hit 37.6 trillion, and despite the record valuations, there are deep structural cracks underneath that every investor should be aware of. Hey all, welcome to ShareTreck, where science meets investments, and I'm your host Raj. Friends, earlier I had published a video titled Why the Markets Have Not Crashed Yet. Today we are unpacking what lies beneath the US economy's apparent strength, the numbers, the risk, and the policies shaping the next decade. Let's start with the hard data. The US national debt reached 37.6 trillion at the end of fiscal 2025. That's a debt to GDP ratio of roughly 119%, projected to cross 125 by year end, double what it was in the early 2000s. Foreign investors hold about 9.1 trillion in treasuries, around a quarter of the total. The top holders are Japan, the UK, and China, but most debt remains domestic within institutions, and China is also unloading its treasury holdings and going more into gold. The Federal Reserve and US trust funds are the other holders. On top of that, household and corporate debt has ballooned. Mortgages, student loans, and auto loans are at record highs, and corporate leverage remains elevated. Compared to GDP growth, this is a mismatch that raises long-term sustainability questions. Now let's talk about policies that may worsen these vulnerabilities. First, tariffs. While they have supported some US manufacturing sectors, they have also fueled inflation and triggered retaliatory tariffs that hurt agriculture and export-dependent businesses. Then there's the new H-1B visa policy. Starting late 2025, companies face a $100,000 fee per application for new skilled worker visas. Analysts expect a sharp drop in skilled immigration, particularly in technology, healthcare, and academia. That means fewer researchers, fewer startup founders, and a potential brain drain towards Canada and Europe. Friends, Australia is now struggling with the lack of domestic investment in R&D and is looking to attract these kind of individuals. Likewise for Europe, especially France, as well as the European Union overall, have declared their intention to attract these talents. Add to that the renewed immigration restrictions and uncertainty around deportation policies, both of which could reduce labor force growth and slow innovation. Tourism has recovered since COVID, but a combination of policy friction and global perception issues are holding it back. Friends, if you're finding this kind of a breakdown helpful, please do not hesitate to hit the like button. It helps more investors and viewers like yourself discover our channel. Despite all this, markets remain euphoric. The S&P 500's price to earnings ratio is well above its long-term average. Market cap to GDP, which is a Warren Buffett favorite indicator, signals potential overvaluation. Credit risk spreads remain tight, suggesting complacency, while yield curve inversions have persisted intermittently since 2022. Yield curve inversions are a classic recession signal. On top of that, gold has climbed from 1,500 pre-pandemic to all-time highs of around 3,800, showing persistent inflation fears and demand for safe haven assets. Zooming out, the US share of global GDP has fallen below 25%, down from approximately 40% in the late 20th century. The US dollar still dominates global reserves, roughly 58 to 60%, but that's slowly eroding as China and other blocs diversify. Persistent trade and current account deficits compound the problem. Meanwhile, foreign sentiment towards US debt is mixed. Japan and UK remain strong buyers, but China has been steadily cutting exposure. These shifts hint at what economists call bond vigilante risk. If confidence drops, yields can spike rapidly, forcing fiscal tightening as we saw in the 1980s and 1990s. AI adoption is transforming productivity in finance and tech, but job creation isn't keeping pace with job loss. Labor participation remains subdued, which adds pressure on growth and consumer demand, both vital for debt sustainability. And on top of this, we also have this fog of data, I would say, because private sector data like the ADP payrolls is coming out on a consistent basis, but BLS data is now suspended until the shutdown is taken care of. So the question now is a crisis inevitable? Not necessarily. The US still has unmatched advantages, the world's reserve currency, deep capital markets, and the most powerful innovation ecosystem globally. A soft landing could emerge if growth stabilizes, inflation moderates, and fiscal reform gains traction. But the risks are real, particularly if foreign confidence erodes or rates rise faster than expected. Keep an eye on yield curves, treasury auction demands, credit spreads, net capital inflows, real wage growth, debt servicing costs as percentage of GDP. All of these factors can give you a clue. And from an investment perspective, the US remains investable, but far from invincible. This is a market that demands selectivity, vigilance, and global diversification. Right now, Wall Street seems to be disconnected from Main Street, chasing momentum while ignoring weakening fundamentals. Some call it an AI-fueled bubble. Others say it's retail investors driving the market through steady monthly inflows, while hedge funds stay cautious on the sidelines. Whatever the cause, this is a trader's market. If you're not long, you're missing daily gains. But if you're not alert, a sudden reversal could erase all your gains equally fast. And if you sell on a false alarm, re-entering at these elevated levels can become even riskier. So the real question is, are we heading towards a fiscal reckoning or managing another soft landing? I would love to hear from you. What is your take? Share your thoughts in the comments below. Also, friends, I'm happy to announce that we now have a Substack, a ShareTreck Substack. And my first post is a detailed essay on this video with more data and information. You get access to the raw data that I have been using and my original write-up, which forms the basis of this video. Subscription is absolutely free, so please subscribe so that you can see the detailed information that may not come through in the shorter videos that I publish here, in the interest of keeping it brief and catering to the average YouTube viewer. Thanks for watching this video. If you haven't subscribed yet, please subscribe to help grow this channel. This brings me to an end of this video. Bye for now. Have a great weekend, my friends. See you later.